I would say we can start now.
So, good morning, everyone. Thank you so much for participating to this webinar organized by FEPS and ECRI. It's a pleasure to have these experts today with us. We'll have Luis Del Olmo from the European Banking Authority, Matthew Osborne from Ripple, Mark Foster from the Crypto Council for Innovation, and Alexander Höppner from Unity. As you see, a very interesting lineup of experts. Why have we decided to celebrate this webinar in FEPS-ECRI? So the main reason is that, as you know, MiCA will become fully applicable at the end of 2024. At the same time, Donald Trump will make it to the White House at the beginning of 2025, and he has made some clear statements about crypto assets. So we think it's now time to discuss what kind of regulatory framework we have built up in the EU, what the opportunities, what the challenges around it are, and whether there are chances for regulatory convergence with the United States. So what we're going to do is we're going to have 4 rounds of discussion with the panelists. And at the very end, we will take questions from the audience. There's a Q&A bar where you can write during the event your questions, and we will take those at the end. So let's start with the first round. There's a tendency to believe that crypto assets, or to fully identify crypto assets with Bitcoin. But the truth is that there's much more to the crypto world than that. And there's some real life use cases. So let's start with the use cases for the financial sector. I'd like to give the floor to both Matthew and Alex, so that you explain some of those financial use cases. Maybe you can start, Matthew.
I'm very happy to. Thanks, Judith, and thank you very much for having me on the panel today. So I'll say a little bit about Ripple because I think it's relevant to this question. So we are a digital assets infrastructure provider to financial institutions, and we've got a product stack covering cross-border payments, custody, tokenization, and DeFi. And we're shortly also going to be issuing our own stablecoin called RLUSD. So what I wanted to do is to say a little bit about the payment solution that we offer today, and then explain the rationale for issuing the RLUSD stablecoin too. So Ripple has been around for over a decade now. We're quite unusual in crypto companies in that we've got that quite long history. And our key focus has been using crypto and blockchain technologies to create value in the real economy for institutional customers. And at the heart of that, during our history so far, has been the development of cross-border payments products. to make payments more efficient, quicker, and cheaper for our customers. So I'll explain a little bit how that works today. So we work very closely with the XRP ledger, which is a decentralized blockchain ledger, and that has the XRP crypto asset as its native asset. So when a customer sends a cross-border payment, they get onboarded. The value is then transferred across the globe using that XRP crypto asset. And then the value is then offboarded again at the other end to convert into the fiat currency that the payee needs. So there are different versions of the product we offer today. The most recent version of that, which we call is a product called Ripple Payments Direct, involves customers keeping their funds with Ripple, so we can actually manage that process of on and offboarding behind the scenes for them, making it even more efficient and generating more value for our customers. So that payments product has been very popular. We have hundreds of customers for that today in around 55 countries globally and spanning a range of different industry sectors. So what we saw was increasing demand from our customers for a stable settlement asset, a stable coin that is issued by a well-respected and reliable issuer. And so what we've done is we've built the RLUSD stablecoin with compliance across major jurisdictions in mind. We work exclusively with tier one banks for the backing assets. We also have an advisory council that includes a number of very experienced regulatory professionals in the US. And so the idea of this RLUSD stablecoin, it will be used in our payments solutions. So people will be able to settle using RLUSD alongside the XRP stablecoin, which will continue to play a key role. And the stablecoin will also be available for use within institutional and DeFi use cases on the platform as well. And we'll issue it not only onto the XRP ledger, but also onto the Ethereum blockchain as well. So it's available for many different use cases.
Thank you so much, Matthew. Alexander, any other financial use cases on top of cross-border payments as just flagged by Matthew?
Thank you very much, firstly, for having me. And just quickly, AllUnity is a company founded by DWS, Galaxy, and Flow Traders, and we applied for an e-money institute license to list an e-money token in Germany under BaFin rulership to list a digital euro for the Eurozone. We haven't received the license yet, but at least then you know what we plan to do. So for me, when I was still CEO of Börse Stuttgart and we announced to go into crypto trading and tokenization in 2017, we had a lot of corporates talking to us on tokenization projects. And that was mobility, energy, real estate, machine-to-machine payments, and what have you. And back in the time, and also the financial world, because I was coming from Börse Stuttgart and before that Deutsche Börse. But back in the time, the regulatory framework was not already settled. MiCA is so much more because it allows you technically to tokenize whatever you want to tokenize. And when you think about especially the classical financial market, a lot of security measures are institutionalized, especially when it comes to post-trade. So Deutsche Börse at the CCP, we have the clearinghouse and all the processes that you need to process global transactions. And if you think that this can be now on a different technical basis, that was all the ideas back in the time 2017, but the framework was not there. And now the framework is there, but the cryptocurrencies used before had the problem of the high volatility. Nobody wants to use Bitcoin now. 100,000 for margin currency for future or an option or a perp. So this is why we need the stablecoins. And having regulated stablecoins under the MiCA regime really now allows you to tokenize everything and have a normalized transaction medium, whether this is cross-border payments like the Ripple guys are doing that fantastically, or whether this is machine-to-machine payments, or whether this is a margin currency or future or an option. whether this is ultimately some other payments that you want to do, remittance payments, a store of value, all these things which Tether does fantastically, not so much for trading. It's banking the unbanked and the store of value in high inflation rate countries. So there's a myriad use cases that you can actually kick off now that you have a legal framework, because the problem beforehand was that for you and me, trading a little bit of futures on some weird exchanges in Asia is not a problem to have that unregulated. But if you're a big corporate, let's say you are Deutsche Telekom, you have everything on chain anyway, and now you want to add the payment layer on chain, it is impossible to do that in a fully unregulated world. And so you need a regulated framework to actually now be able to tokenize the projects. And to really be in the digital world, you need the cash lag on chain too. And that is the big game changer, I think, that now comes into place with MiCA, where from my point of view, European regulators are really on the forefront of the development. Maybe let's see what catches up on the US side. So for me, it's threefold. You have the classical crypto trading universe, especially when it comes to derivatives markets, where stable coins are used as margin currency, and over the top leading cryptocurrency exchanges, like 100 billion, 120 billion per day trading volume, 90% of that is still the BTC USD perpetual swap. And then you have the range of services that Matthew also tapped into. So all around payment services, banking, finality of payment, cross-border transactions, remittance payments, a store of value. And that is then actually already the bridge into the real economy, maybe over the treasury management sections of the corporates. Because if a treasury manager gets the funds, instead of 5 days waiting for the funds a couple of seconds later, they have a lot to maneuver. They have a lot of to gain. They strike out the market price risk, the counterparty risk. They can invest the money or can generate interest on the money that beforehand was time needed for the cash to transfer from one jurisdiction to the other. And then we come to the real world use cases, where, as I said, it's like mobility, energy, or real estate, or other token ideas that are currently driven, which are essentially a bridge between classical products and the financial world. Because what we do ultimately is we put the cash lag on chain. And maybe here make a quick stop.
Thank you so much. I know Mark is a great defender of the underlying technology, the use cases this could bring. So, Mark, could you please explain to us some use cases that are not necessarily financial use cases, but that can bring a lot of added value to the financial world?
Yes, of course. Thank you, Judith, and thanks to everyone for joining and for the invitation. So my name is Mark. I'm the European EU policy lead for the Crypto Council for Innovation here in Brussels. We are a relatively small but global trade organization representing the interests of our members. And we have members right through the technology stack, which is quite interesting, from exchanges through to the protocol layer, online platforms, etc. So that gives us a good overview. And just building on what Matthew and Alexander said, I mean, I think stablecoins are a really important link between the kind of financial world and then what we see as a very exciting evolution in terms of Web3 and real world use cases. So combination of either stablecoins and tokens and tokenization are hugely important. And I think the regulatory clarity that the MiCA has brought, at least in the EU, and then as other jurisdictions catch up as well, will enable exponential growth of some of these different kind of use cases. As ever with policy, it's always about trying to create the narratives around why people should care. And at CCI, we try and identify these different use cases. So we've got a section on our website called Crypto in Action. There's a couple of excellent use cases in there, which are non-financial. And often it's outside the EU rather than in the EU, where some of these use cases are most prevalent. And I think that's quite an interesting point to bear in mind as well when it comes to legislation and regulation. We often see things through a European or a US perspective, but there's a big world out there, and there are some interesting things going on all over the place. Two that I'll mention in terms of a collaboration we have with Mercy Core Ventures. There's one which involves a climate insurance pilot in Kenya. And essentially that's similar to a stable coin, but it's using the features of a coin to reduce transaction costs and to make donations instant settlement that you get for donations, enabling that money to be able to use in the way it's intended for farming and agriculture in Africa. There's another project that we're doing in terms of we're supporting and working on in terms of peer-to-peer water management, which is done via a DAO, so a decentralized autonomous organization. And again, that's an example of how not really financial, but it always comes back to the stable coins and the ability to be able to kind of finance and transact across the globe. In terms of some of our members, I'll give you an example, two more examples, if I may. One of our members is Filecoin Foundation. They're doing a lot of work around decentralized data storage. And again, that's a super interesting kind of case study for the future, perhaps more so than maybe now. But again, there's most of the Web 2 world is through centralized intermediaries, big players, and Filecoin are looking at ways of decentralizing some of the data storage and sharing of data in order to make sure that you can access data from a point that's closer to where you are, which also has energy consumption and sustainability implications, positive implications there. And then one final example, there's lots of work gone in Europe in terms of the EIDAS framework, so for identification. We've also been doing some work in the past with Spruce ID. They are looking at decentralized identification and authentication solutions so that we as individual citizens can prove who we are vis-a-vis different authorities. And we will all have experienced, even in the European Commission, when you have to give all of your data, including your birthday and your date of birth and all private information, which becomes a honeypot then and potentially risk for hacking. There are now zero-knowledge proof solutions whereby you as a data holder can give your consent to the interlocutor to prove just that one point that you need. So whether it's whether you're old enough to drink in a bar, whether you have a driver's license or not, just an ability to be able to have a technical solution to say, yes, here's the authentication and proof that I, as this person, am allowed to do this. And again, obviously, the financial side always comes through whenever there's interactions when it comes to transactions and things. So a few examples there from across the globe, but I don't want to say that MiCA and the financial use cases are not important. They are hugely important, and they are for our members as well. But the next 5 years, perhaps in the Commission and in Europe, we might be doing some more work in the non-financial space as well.
Very well, very clear. Thank you so much. And Luis, basically, what I tend to see is that at the very beginning, crypto, in terms of the whole financial system, was pretty much in the sidelines. But now I see growing interest by traditional financial players in getting engaged with cryptos. And indeed, a few months ago, we drafted a paper on that at FEP's Equity. So how do you see this from the European Banking Authority? Do you see indeed this growing interest by traditional financial players? And what's your views on that?
Yeah, thank you very much. Good morning. Indeed, here at the European Banking Authority, we've been pretty busy from a double angle, from a double perspective, I could say. First, from a regulatory point of view, where we received plenty of mandates to draft and elaborate technical standards following MiCA, but also preparing for our supervisory role in the future. We paid particular attention indeed to the interconnectedness between the traditional banks with the new actors in this market, and how they indeed perceived interest in these activities. And we took it very much into account in the development of our standards, trying to assess in the most balanced manner benefits, but also risks that could arise in this context. We, at the moment, see indeed that there is some interest from traditional banks, let's say, in this business, still slowly growing, probably with a little bit of cash so far, but in progress indeed. So how do we see this involvement of traditional banks from a regulatory and from a supervisory perspective? Well, basically, we see it from two angles as well. I mean, banks may intervene, may act in this business as deposit-taking institutions from mainly e-money institutions is something that comes directly from the regulation, from MiCA. It could be indeed an opportunity for them to develop business activities, ultimately in the traditional lending activities. And of course, this is something that we pay very much attention and we took very much into account when developing our standards to indeed ensure, on the one hand, that the final standards would provide the necessary, let's say, framework to allow to develop this business, while at the same time trying to seek for ensuring or mitigating potential new risks arising here. You know, in MiCA, there is, particularly for e-money institutions, relatively strong requirements for e-money institutions to place deposits with European credit institutions, around 30 or 60% of the amount of their reserve of assets. And therefore, this is an important link with the traditional banking system, which, as I said, has pros, but also has risks. So it's about how to deal with that in the most appropriate and most balanced manner. We try to incorporate some elements in our regulation to try to address this situation without, at the same time, triggering barriers for the development of these activities, but minimum expectations in terms of diversification, maturity profiles, liquidity soundness. I mean, it's something that we understand is necessary first for the e-money institution to be able to develop in a safe manner these new activities, but also from the perspective of the banks to ensure that indeed these activities would be developed with the minimum possible risks. On the other hand, also, traditional banks might act directly as issuers of tokens, of course, in both e-money tokens and also asset reference tokens, for which, again, there are good regulatory frameworks in place. In MiCA and in the traditional banking regulation, you know that for banks, when they basically might seek to issue directly e-money tokens, the regulation, the banking regulation would apply, for which sufficient safeguards are already in place. When it comes to issuing asset reference tokens is when now MiCA also enters into place with the reserve of assets, and therefore also we develop the standards taking this very much into account. So I would say that at the moment, maybe to conclude, I would say that we see that there's some growing interest in these activities by traditional banks, but we took it like with a little bit of, let's say, care, in the sense that they are also assessing the opportunities, also assessing the risk, which is good. And that we have tried to also in parallel in the regulatory framework and also in our preparedness for the supervisory rules to make sure that these things might happen in the most safe manner, let's say. Yeah.
Thank you very much, Luis. So now moving to the second round. I mean, you just said it before. You have been working very much from a regulatory perspective in the level 2, level 3 of MiCA. Many times we only think about level 1, but I know that there's a lot of work there. So how has been this experience, and what benefits do you think that having a clear regulatory framework could bring for the EU?
Yeah. Thank you. So, yeah, indeed, as I was saying, basically, I mean, we have indeed had to face material challenges in terms of developing our role here, because indeed the urgency and the time frame was pretty tight for us to from a regulatory point of view, drafting time the mandates that we had to meet in terms of regulatory standards. And also for the preparation of our supervisory role. Generally speaking, I think that we assess very positively the fact that we already have a regulatory framework in place. I think this was indeed very necessary, taking into account the evolution and the expectations of the business, the trade volumes that we started to see growing little by little, but still growing, and also understanding also the appetite that exists indeed at the moment. So for this, we understand that the contribution of MiCA regulation and the subsequent technical standards will contribute very efficiently to ensure a proper regulatory framework, providing certainty in the market, in the investors, and ultimately for the benefit of all the agents participating here. That's for sure. Also, I would say the same from a supervisory point of view, the fact that also these institutions will be subject to ordinary supervisory framework is also something that at the end of the day basically is for the benefit of all for the benefit of the institutions, for the benefit of the final investors, and for the development of this activity. Maybe I would also like to flag the expectations also in MiCA for transparency, which is also very important, starting by the white paper, but also any other documentation. I think this is very important for ensuring that market participants will be able to be updated and informed about the characteristics of the different products that will be offered in the market, and at the end of the day are for the benefit of all, for the benefit of the development of the activities, the investors and the institutions. So I would finish here. Thank you.
Thank you very much. We'll have the time to discuss the obstacles or the challenges that arise from MiCA in round 3. Now let's basically focus on advantages. Matthew, I know that one of the advantages that you value the most is passport, that getting the license in one member state will bring thanks to MiCA. How do you see this? What benefits do you think this could bring for your activity?
Yeah, thanks, Judith. That's right. So I mean, MiCA has a number of advantages. Probably the main one is just the degree of regulatory clarity that it's brought to the market, and in that respect, it's encouraged an investment in the EU. Lots of firms are setting up in the EU. It's a real sort of positive step forward, I think, in an area where the EU is leading the world in providing that regulatory clarity. But you're absolutely right, Judith. So from the perspective of Ripple and other international firms accessing the EU, it's the passport that's contained in MiCA that's the absolute key benefit, and a really important competitive advantage for the EU as well, because this allows a firm to get a license in one EU member state, and then using that to passport, we can then access the whole EU market of 450 million people. So that's a real key benefit, and I think a great achievement of the EU. And then so each national competent authority in a member state would then be assessing applications for firms from a license using the same standards, the same level 1 and level 2 rules under MiCA as well. So it's of great value. But I would say, I know we're talking about the benefits, but let me talk a little bit about the challenges of the passport here too. So the level 1 and level 2 text create a great opportunity for using the passport, but there are some frictions as well. So in particular, differences in the approach taken by different NCAs, differences in how easy or difficult it is to get a license, which can vary between different supervisory authorities. There are also important interactions between MiCA and other pieces of regulation that aren't harmonized. So MiFID is a really good example of that, where actually different member states take quite different approaches to defining what is a financial instrument. And then that in turn, there's a sort of domino effect. That then means there are variations in the definition of crypto assets under MiCA, because those two pieces of regulation sort of interact with each other quite a lot. So I would say the passport is a huge opportunity. It's a huge benefit, but it does need work to maintain it and make sure that it continues to be effective.
Thank you very much. I think that you have set a perfect scene for the intervention by Alexander, with whom I had a very interesting conversation. And it looks like the value of the licenses is not the same depending on which NCA is granting it, which I was very surprised about. Alex?
Yeah, maybe. Thank you, Matthew, because you tapped directly into that one. I think this is like you described it, this is not a secret. Yeah, we have a European rule set, but there are differences how national regulators are looking and interpreting the things. And I'm not applying for a MiCA license. I'm applying for an e-money institute license of Germany. that has to follow the MiCA rules. And so if I would apply for a European license on a European level, then absolutely, but I don't. I apply for an Irish license, or apply for a license from Netherlands, and we apply for a license in Germany. And actually there, the attitudes and the way to look at and to interpret the law might be a little bit different. I mean, there's a reason from my pastime why all the bonds issued from German banks are not issued in Germany. They're issued in Ireland or Luxembourg, although they were traded at my exchange in Stuttgart. Yeah, so there are differences, and these differences have an impact on how fast you get the license, how intense, how long your discussions are, also how costly the discussions are, but also how the licenses granted will be seen by especially large institutions. And it is not, I'm not evaluating that. Maybe I should say this as a saying. We have a European rule set, European citizens, so don't get me wrong on that one. And so I deliberately make an example from outside of Europe, and I hope that I'm not stepping on anybody's toes here. It's just a fake example, right? But getting a license granted in Canada has a different impact than Panama. It just has, even if they have the same rule set. And it doesn't matter if you do business with retail clients, then a license is a license, might be enough. But it is a big difference if you make a corporation or a deal with a big, large corporate, especially if the corporate has a strong compliance and regulatory framework and rule set, then it definitely makes a difference. Another example, when I back in the time announced I do this license application from Stuttgart, we got invited to the South Korean parliament and to politicians in Japan because we did this in Germany and not went to some other country. Not saying that Germany is the best, that's not what I mean. It is still a difference of how the national authorities interpret it and run it and rule it and how complex it is. And yes, from a startup or company standpoint, that can be negative because it takes longer, costs more money. But it can also be seen as a positive thing because some regulators still have the reputation to be more thorough or more painful also. But in the end, assure by this, maybe a stronger compliance or a more conservative view on the compliance. Although technically speaking, through the passporting, it should be all the same. But it's just matter of fact. And I think we all know about this.
Okay, so basically what I take with me is that the passporting works pretty well for retail customers. But when we're talking about big corporates, then they go into the nitty-gritty about who granted the license, under which conditions.
No, Judith, maybe then I missaid this. No. From a passporting standpoint, that's the same. That's the same. But if you're a big corporate, yeah, and you want to decide to use a certain partner, and there's one partner having the license received here, and there's another partner having the license received there, then maybe you, and I deliberately make now a different example, then maybe you rather go to one that got the license in France than somewhere else. Yeah. And so this is when it looks, when you look at this. So it's not for, you just want to use it. It's a normal service. You don't have a corporation with that issuer or with that company. You probably don't care. Yeah. But if it is really a strategic decision and you have a very strong compliance framework yourself and governance yourself, then very often the legal colleagues from your company or the compliance colleagues from your company feel much more comfortable if you come from a, let's say, very conservative regulatory framework than maybe some which is more innovative and more progressive.
Perfect. Thank you. Thank you so much. Now, Mark, recall that this round is more for the advantages of MiCA. We'll discuss the obstacles, the challenges during the third round. So what benefits do you think that MiCA will bring?
Okay, very good. I think building on what Alex said there, I mean, I think it's a challenge to Luis and his colleagues at the EBA and the Commission to make sure that, the political intentions, which I believe was the case when MiCA was established, is to raise the bar, to have that convergence and to raise the bar. So, we've also struggled a little bit with grandfathering and things. We can talk about that later. But the intention should be to get rid of that. You have a single rule book which applies to 450 million citizens as individuals and businesses, and it shouldn't matter, who your national competent authority is, because the rules should be enforced in a consistent manner across the EU. And I think that we need to keep that in mind. That was a positive intention originally of MiCA, but it will take a bit of time to get there. And of course, having one set of rules that are clear and defined and enforced consistently is much better for businesses that are acting globally or even within the EU than a series of different regulations. So, I think that's one of the positive elements I'd mentioned, building on what Alexander said. The other things are really, our members are global. A lot of them operate in the US. And whilst people won't agree exactly 100% with everything that MiCA did, and there will be a couple of things that we can talk about later at level 1 or level 2 or level 3, we hugely welcome the fact that there was the legal certainty that came from the regime. Much better to know what the rules are and then be able to have a process to discuss, have conversations around licenses, understand how the supervision will be, than a vacuum. And in different parts of the world, there has indeed not been a clarity there. So the European Union moving quickly, being one of the first, showing some leadership in that sense, I think was hugely welcome. Another benefit of MiCA is clearly the protections that brings, I think, both for firms but also for individual retail investors. MiCA obviously applies to intermediaries, both in terms of the exchanges, the cash rules, and then the issuers and the stablecoin rules, simplifying it a bit. But they're the major elements. And the foundations are something that I think any reputable and global firm would accept. It's disclosure and transparency that Luis touched upon. It's reporting standards with white papers. It's asset segregation. It's some supervisory rules, fit and proper to a certain extent. So these are all building blocks that are inspired from TradFi, and we need to make sure that as we do MiCA implementation and as we think about the development of frameworks, they don't always need to be legislative frameworks. But as we think about frameworks in other parts of this ecosystem, we need to be careful that we don't just necessarily copy and paste things over, or say, MiCA 2, or we just do MiFID again for an ecosystem. That won't work for Web3. So we need to be very mindful of putting in place the frameworks that are appropriate to ensure the innovation can continue, and that we can build the services and products for the future. And then my final point would be the positive thing that MiCA brings is a certain amount of credibility and trust. And that comes back to the fact that, these are now regulated entities in a large market with reputable and robust supervisors. And trust in any market is hugely important. But in this market, which is global, and where there have been examples in the past when it was unregulated of bad practice and abuse, which we also see in TradFi as well, by the way, over the years. But nevertheless, having a clear framework will hopefully enable individual citizens and consumers to understand that this is a serious market, a serious part of a growing and evolving payments landscape and financial services landscape more broadly. And that should give people the confidence to get involved in this area even more.
Thank you so much. So basically, the advantages that I take with me are, first, legal certainty. That's clear. Then the protections that MiCA brings, so in terms of transparency, reporting standards, asset segregation. Also, the passporting, though I understand from both Matthew and Alexander that there are some frictions with other pieces of legislation, and also with how different NCAs are perceived. And finally, it also increases the perception that this is a serious market, so we could indeed increase the relevance of cryptos going forward in the EU. So now let's move to round 3, where we're going to discuss the hurdles that you identify in MiCA, not only level 1, but also level 2, level 3. So back to you, Mark, because I know that you have a list of those. So please go ahead.
Thanks very much. No, I mean, I'm sure other participants will have views as well. At a kind of very high level, I think one of the things that, if people have been working in EU policy for a long time, like myself and like the other panelists, understand that you have the difference between the level 1 and the level 2. And we understand that, when there's a political agreement at level 1, if they can't agree, well, maybe we just get, EBA or ESMA to do some technical work. And so I have some sympathy with Luis and his colleagues that are given sometimes mandates that might be political, or a framework where they need to then fill out more details, and a very short timeline in which to do it. And one of the hardest things for businesses, as everyone on the call will know, is, we all need to and want to be compliant and apply the rules from when they apply. But when there is such a significant level 2 and level 3 mandate given, and the resources being as they are, it's a huge challenge for the ESAs, but then also for industry to be able to, understand, engage with that process as the rules are being drafted, and then get the business, in a place to be able to apply the rules from day one. So, EBA have done a lot of extremely thoughtful work, as have ESMA. We're still waiting on some of the ESMA work, the third package in terms of classification of assets, still not here yet. And MiCA obviously goes live in its entirety at the end of this month. So that's a challenge. In terms of some of the rules around stablecoins, I think where MiCA level 1 did a very good job of setting out a framework, requirements, but kind of still at quite quite high level. One of the concerns is that whilst we understand EBA and ESMA need to provide more detail, if you look at all of those RTS mandates, it becomes really, really heavy and really detailed. And again, this is no criticism of Luis and his colleagues. That's the role they've been given. But some of the aspects there were probably established in a political context from a couple of years ago, and we've seen the market and the ecosystem evolve since then. So one example is the ESG reporting. Now, ESG reporting in across TradFi as well is something that is difficult to do. We need the data quality. We need to make sure that it's standardized. People don't have a problem per se with the idea, but it's a huge burden there. And that came from the conversation in the Parliament, you'll remember, around banning proof of work. And then the compromise was, oh, let's have some ESG reporting. As I said, the ecosystem has moved on now. Ethereum has had the change. And so whilst energy consumption and the ESG side of any financial instrument is important, I would question whether we need that level of granularity and how useful that's going to be. And you could extend that logic as well to some of the other reporting requirements, some of the reconciliation that some of the stablecoins need to do for their reserves, and some of the reporting requirements there in terms of how you define transactions, one leg, two legs. Are they both in the euro or in a currency of the EU? That all has impacts in terms of some of the thresholds and caps that have been put in there again for political reasons, which are understandable in terms of monetary sovereignty. And we also have to remember that a lot of the logic for MiCA came from the concerns around Libra and Diem back in the day, with a huge big tech, so Web 2, not Web 3, company potentially getting involved in these markets. So the reporting requirements are significant. And then, as I said before, a lot of the trust comes from the regulatory framework, and that's great, and being supervised entities, and no problem there. And having things like capital requirements, liquidity rules makes sense. I think, again, some of the level of granularity probably make that difficult. So if you look at the concentration limits, for example, you already have a one-to-one reserve requirement, which is the opposite of fractionalized banking, as lots of the colleagues on the line will know. That is already a huge safety net for citizens. But then when you have the concentration limits in there as well, in terms of high quality liquid assets having to be held in a bank, that would require potentially some of the crypto native firms and some of the stable coins to have multiple banking relationships within the EU. And the EU actually is not as bad as some other jurisdictions in the world in terms of having those relationships. And I think MiCA will help with that. But traditionally, some financial institutions have not wanted to have relationships with crypto because they've seen it as a high risk activity or a high risk area. And I'm not talking about them issuing crypto or having exposures to crypto. I'm talking about just basic banking services so that crypto firms can pay payroll and things like that. So those requirements in MiCA of, potentially, I think it's 10% or 15% limit, would require some firms to have, 8, 10, 12 banking relationships across the EU. And that we think is probably excessive, given you already have the one-to-one reserve requirement as well. But as I said, this is nothing against Lewis and his colleagues. We know that this comes from the level 1. So looking forward, when it's crypto or digital assets or even TradFi, maybe something for the new commission to think about will be the extent to which we need all this level of detail. Do we really need this? Is this having an impact on innovation and competition? Obviously, Mario Draghi and others have looked at this. I think that the work that EBA and ESMA do is hugely important, but maybe if the legislators and the Commission as the initiator of legislation think more carefully about what they want from the ESAs and then have the ability to be able to resource that properly, where we can have consistent, harmonized rules at EU level, is much more advantageous than 27 sets of different rules. But we need to think about whether we really need to go quite as granular in the future. That would be my main point.
Thank you very much, Mark, and fully agree that at the end of the day, the SAS are just do what they are asked to do. So what we are also requesting from THEPS, and we did this a couple of months ago in a task force report on the future of financial services in the EU, is to progressively move from very detailed financial regulation to principles-based regulation. We know that it's very difficult to move from one place to the other, and basically sometimes principles-based regulation is not also the optimal result. So sometimes it's indeed too general and could create legal uncertainty, but not to be so detailed. Indeed, it would make much sense. So now, Matthew, what are your views on what obstacles MiCA, irrespective of its level 1, 2, or 3, is creating?
Thanks, Judith. So a couple of points I'd add to the excellent points that Mark made just now. So one is short term and specific, and the other is more big picture. So on the first, Mark mentioned the challenges created by the large volume of new rules produced by the ESAs. The challenge for firms that are applying for licenses under MiCA is that actually quite a significant section of that rulebook is actually not finalized yet, and might not be finalized until the new year, actually after the point at which MiCA takes effect. So you actually won't have a complete rulebook on day one. And that's actually creating a lot of uncertainty and a lot of legal risk for firms that are operating in the space. And it also has a knock-on impact because firms, a number of national competent authorities actually aren't open to applications yet as a result. So that means firms can only start applying for licenses next year. And then MiCA has a limited transition period for existing licenses. In the level 1 text, it allows for a maximum of 18 months, but the NCAs can reduce that with a discretion. ESMA has recommended that NCAs should adopt a 12-month transition period, so than what's allowed by MiCA. But then actually the NCAs have taken very different approaches. So some have gone for longer transition periods, some have gone for shorter transition periods. I believe some don't have a transition period at all. So again, that really compounds the challenge for firms, because a firm with an otherwise very good application could find itself simply timed out by that grandfathering period and might then find itself in breach of MiCA if the transition period in the jurisdiction they're applying in ends. So that is something that I think it's really important for NCAs to be aware of and to monitor, because I think there is this balance to be struck between making sure that MiCA is implemented properly and that the risk to consumers, to end users is reduced, but also that this is supportive of the industry and there is a sort of reasonable and feasible way for firms to come into compliance. The second point is a bit is more big picture, and it's about sort of how to regulate innovative industries. I think that the when you're regulating something that's new, something that's innovative, something that's growing, it's important to take a proportionate approach, and also to balance the regulatory objectives against the need for a jurisdiction to stay competitive. And I think that is a key priority for the EU right now, following the Draghi report and the declaration that the EU leaders made in Budapest. I think it calls for a different style of regulation. We've seen that in some jurisdictions around the world. It calls for regulation to be more reflective, to be iterative, to be agile, for frequent review points, so that regulators can try regulation and then fix it if there are some problems, and close engagement with the industry as well to check in on how it's working and to make sure that balance is being struck properly. So there are some features of MiCA that do that. So there are assessments of MiCA that are built into the level 1 text. There's one on the scope of MiCA, which is the end of this year, and then there's another one next summer looking at which is an interim report on the implementation of MiCA. So those are absolutely key opportunities in our view for the EU together with the industry to consider how MiCA is working so far. Are there any things that we might be able to change to make this work effectively without compromising on regulators' objectives, but with that aim in mind of making sure that the EU stays competitive?
Thank you so much, Matthew. Alexander, any additions you'd like to make?
Yeah, maybe a little bit, and but Mark raised, actually, you made a very nice summary of the points I would have mentioned anyway. But let me just quickly, rarely, and I have applied for a lot of licenses, have I had such a positive discussion and framework of discussion, speed on the national level as well as on the European level as with this one. And we can complain up and down the hill. Yeah, we said it before. I mean, we're the first globally with 450 million potential customers. I mean, that's unique. That's fantastic. Is everything perfect already? No. Whatever, doesn't matter. We have something, and that's stability. So let's go for that. But what Mark raised is really practically really hitting us very on a very detailed operational level. It's like, yes, fantastic. I don't have to go to 10 different banks anymore. Yeah, when I become significant. So I can go now with 4 global banks. Okay, awesome. But then on the other side, if I go into high quality liquid asset funds, then all of a sudden I can only tap 5% into one fund with one fund manager, or do I have to have now 20 fund manager? And are there at all enough in Europe so that I can be compliant on the European level? And then it hits me really, because although I'm applying for an E-Money Institute license, so Germany, you know, German words, Zahlungsdiensteabwicklungsgesetz, that's my license. Yeah. So who cares on the European level? That's my license. Yeah. But everybody evaluates my company as a crypto company. So if I run for just getting a transaction bank account, I'm treated like Binance. And guess what? Now I need to have 20 asset managers in Europe that want to work with me. That's my problem. So I'm going to be fully compliant. I'm running this, yeah, in the European jurisdiction, but I'm still treated like some outside crypto trading firm. Yeah, and that creates a huge problem. Yeah. So is already settled? No, it's not. Can we be more reactive? Yes, to Matthew's point. But then we should be also fine if some regulation might be a little bit too loose or a little bit too tight. Yeah, for the tryout period, and not everybody complains and bashes on the regulators then once again, like we happily do. That would not be fair. But then we should also treat the companies who want to tap into, let's say, tokenized assets and e-money tokens. They are financial institutions or they are service provider, infrastructure providers, and they're not on the same level as maybe some crypto derivatives firm that's located in some Asian country. Yeah. I think that's a big problem, and that creates a lot of problems that we have. And then comes a little bit this, what I raised before, national law to European law. So now the ZAG says my reserve bank has to be in Germany. Under MiCA, my reserve bank can be in Europe. And now I do what? Yeah, and who's saying, can I go to Europe now? Yes, MiCA says so. Yeah, but I don't get the license from Europe. I get the license from Germany. And Germany says you have to have a German bank. So are there enough banks in Germany? I doubt it. Yeah. So these are the things. We'll find a solution to that. As said, the discussions are very good. It's not complaining here. I'm just raising the points that now in the operational implementation need to be settled. I mean, theoretically, probably nobody could have thought about it, but now running through the licensing process, we find and stumble over these points and we address them, and now they need to be clarified. But these are the really practical things that are hitting us on a daily basis.
Okay, thank you. Thank you so much. So I took note of some hurdles, like, of course, pending as my work on the classification of assets, and if this is not made public before the year end, so indeed MiCA will become applicable, but there will be something lacking in between. Then some other issues are just a result, I understand, of political agreements like ESG reporting. First, it's a bit overall in financial regulation, and then I understand that this was a political compromise not to ban proof of work consensus mechanisms. The concentration limits, the point is well taken, especially if you need to have all those banks in Germany. It becomes increasingly difficult, and this also is linked to different requirements depending on the NCA, and this is a reflection of these are also the transition periods. And then we have a general point that not only affects crypto assets, but when we are regulating innovation, that we need a different type of regulation, more agile, which, I mean, it's a bit difficult, I would say, in the EU, knowing that we have the co-legislators, but still maybe it's something worth trying. So Luis, before we move to round 4, would you like to react, knowing that none of this is the fault of the EBA, but maybe you have some reflections to share with us?
Yes, of course, and I very much appreciate the comments. A good point for discussion. There are some points that I fully agree. I mean, I fully agree with time challenges. This is always the case across the board. I mean, this is not the first time. It happened the same to us more than 10 years ago when we had to basically develop all the banking regulation. Is something that is pretty difficult to tackle, but okay, we are trying to do our best on these things. I also fully agree with the point Matthew made. That's been our intention. We try to seek for proportionate and balanced approaches, trying to seek the best solution between here, basically offsetting risks and benefits. It's not something easy to be done, particularly when it comes with, as you said, innovative activities, new risks, new opportunities. We need to be careful with this. This is the first time we tackle this point, so I think sometimes it's better to try to go little by little and then to be ready to act as needed in the future, depending on how things evolve. And maybe I'd like to make a couple of points about the concentration concerns that have been raised, because I think that probably the most pragmatical points, and maybe just to clarify a little point, some points maybe I didn't understand well, or maybe this was not well understood. So, I mean, first of all, I think that when it comes to the concentration limits with the deposits, we need to very much take into account that we are very much referring to e-money tokens, where there's a significant requirement in MiCA already to have 30 or 60% of the amount of the reserve of funds in form of deposits. So let's go for the 60%. It's huge, right? I think we can all agree that here there is a significant counterparty credit risk that is already. I mean, I'm not criticizing the 60%. I'm sure that it's there for good political reasons, for good technical reasons as well. But it's true, factually, and we have stated this in our products that okay, it's a significant amount, and it can trigger indeed counterparty. So I think we all agree that some minimum diversification is something that is necessary. In our consultation, we started with, let's say, stricter thresholds that we have significantly reduced to the extent that at the moment, when it comes to a non-significant token, you only need 2 banks. And when it comes to a significant token, you need only 3 banks. And we understand that this is not something exaggerated. I mean, 2 banks is the minimum diversification that one might expect. 3 for significant tokens is also something relatively acceptable in our view. Importantly, we are talking about deposits with EU credit institutions. It's not at all by member states. So it's the same if you place your deposits with just to say something, like German, an Austrian, a Spanish, a French bank. It doesn't matter at all from a regulatory point of view. So I think that also in the EU, we have a significant amount of banks, particularly comparatively with any other jurisdiction in the world. We have a lot of banks, particularly in Germany, particularly in Austria, but in many other member states as well. So I think that there are plenty of opportunities to seek for deposit-taking institutions in this regard. And I also like to refer to the concentration limits when it comes to securities, highly liquid financial instruments. That also was raised this point. And also here, I think we need to be very much attentive to the fact that this basically affects, we might expect this mainly affects to e-money tokens, basically. So again, when we go to a significant tokens, let's say 60% needs to be basically in the form of deposits. So it's like about 40% of the remaining reserve of assets that might be placed with or need to be placed with highly liquid financial instruments. And here we are basically following rules, also because this was something that in MiCA we had to take into account, which is, and I think it makes a lot of sense, frankly speaking, to take into account what is required for banks to invest let's say the liquid assets. What type of assets are the required? And here, obviously, when one looks at the liquidity coverage ratio, we have different types of assets. And when we have as a key, the main instrument here, of course, is the level 1 assets, which is basically sovereign and simulated securities, where I think that the 35% concentration limit we have for this remaining 40% is also not something, particularly for in the EU, significant at all, because you could simply diversify across different sovereigns. But you also have the possibility to invest in covered bonds. And then you have the case that Alexander was referring to when it comes to the usage. And when it comes to the usage, we set this 5% by management company. Also having in mind this 40%, we understand that here there are different, concerns or safeguards that we need to have in mind. It's not only about the pure diversification in terms of counterparty or risks, but also the fact that indeed we understand that it is to the issuer indeed to ultimately be in charge of the management of the investments and to decide ultimately where the monies have been invested. We understand that there is already a first mechanism through the selection basically of the management company, which I fully agree that then it diversifies extensively within the relevant fund. Fully agree. But also we understand that it's also pertinent to take into account that ultimately should be the issuer also the one that is basically let's say managing and deciding the ultimate investment of this research. So we understand that, or at least we try to seek for the perfect balance comparatively also with the current liquidity framework that exists for banks, which is for similar purposes. Because at the end of the day, what we are doing is defining eligible instruments that should also be expected to be able to be monetized with minimum adverse price effect, including stress scenarios. So this is very much an important point for us. And for the reasons we were saying, we want to ensure that we provide tools to, at least not to channel all the development of the activities, but at the same time to provide the minimum safeguards for the investors, which at the end of the day is for the benefit of the industry as well. So just wanted basically to refer to this point, but well noted and very good comments. I mean, we will continue monitoring all these aspects and how these are implemented. I think this is the first step, and we will continue following it up very closely. Thanks a lot.
Many thanks, Luis. So now moving to the 4th round, there's an expression that is very dear to me, which is the Brussels effect. And this has not been mentioned. So I thought that maybe when discussing the benefits, some of you was going to say, well, there's the Brussels effect. So this means that we are first movers with regulation and all the other jurisdictions. So will somehow copy what we are doing. And I understand why you didn't mention this, because I have the feeling that this so-called Brussels effect is diminishing with time. And basically now with Donald Trump in the White House, this may become even more difficult. So knowing that MiCA indeed provides protection, but at the same time, if I'm sitting at home and I want to buy something that is not advertised in the EU, I can do it, and then I will not benefit from this MiCA protection. So what loopholes to financial stability you think, Luis, could be in there? And what are your expectations? I know it's very difficult to predict this, but what do you think will happen between the EU and the US when it comes to regulatory convergence?
Well, all this is very tricky. I mean, when we start to talk about cross-border issues, we enter into a difficult terrain. I mean, it has a lot of values. At the end of the day, we are talking about global stable coins, of course, but also it triggers a lot of risks, of course. So we enter into a difficult terrain that we are exploring, that we are working on, that we need to very much understand, because it's really full of possibilities to improve and develop business activities and the good use of the stable coins. But at the same time, we need to be careful with the complexities, new risks and challenges that this can entail. And for this, I fully agree that, and this is mainly for us, we need to very much work and maximize our efforts on seeking convergence from a regulatory and from a supervisory point of view to ensure that these activities can be developed smoothly and as much as possible at a level playing field. It's not an easy task, I can tell you. I mean, we have the experience in banks with multiple standards in banking, in Basel, etc. This is not an easy task, but we are working on this. We are seeking for developments in terms of convergence, as I said, to tackle all these points, all these issues. But there's not a clear answer at the moment. As you said, the EU has really taken the first step, the first initiative in developing the regulatory framework, and also in the implementation of the supervisory approaches immediately. So we will be very much very closely working on this and seeking for the necessary convergence. This is what I can say at the moment. Thank you.
Very well, thank you. I don't know if Mark, you'd like to react on how you see things evolving, and if there is any particular aspect where you think that regulatory and supervisory convergence is especially needed.
Yeah, thank you, Judith. I mean, I think, the Brussels effect is something that is still valid here. The EU moved quite quickly, as we said. If you think when they started with the MiCA process back in 2017, 2018, or whenever it was, the Commission were very early. It's been a long process, as European processes always are. But that did already create a bit of a snowball effect in terms of interest in this. If you look at other jurisdictions, Japan has done a lot of work already. Singapore and Hong Kong are doing things. The Middle East is now very active as well. And so I think the European impetus that was given to the work done by the international standard setters as well. IOSCO have got involved, FSB have said things. So I do think there is something there. As I mentioned earlier, MiCA covers some foundational aspects which are actually not specific to the EU. So we talked about asset segregation, disclosure, transparency. All jurisdictions are thinking about these, and there might be a slight variation culturally or historically as to how these are done, but effectively, the building blocks are there and need to be applied pretty much across the globe. In terms of where there will be kind of alignment, you can hear from my accent, I'm originally from the UK, albeit I've been in Belgium for 20 years and I'm a proud Belgian as well. I think the UK will pretty much stick to MiCA, to be fair. I mean, Matthew might have different views, but the UK wanted to try and take a second mover advantage and try and build a little bit on MiCA and maybe do things slightly differently. Obviously had a government change in the UK as we've had in the EU as well. So let's see. But I expect something coming out of the UK, which will probably be relatively close, be my guess, to MiCA. In the US, less clear. There is a lot of optimism that there will finally be some legislation in the US, probably around stable coins. So more like the aspects of MiCA that are related to stablecoins. I'm not sure whether they'll do something as a comprehensive around exchanges and the other aspects of MiCA when it comes to supervision. But I think that is, again, helpful. It's very difficult to imagine a global regulatory system without some rules of the road in the US. So I think that will be important. So yeah, I mean, as ever in Europe, we need to look at MiCA implementation. We need to try and as Luis mentioned, make sure that we have convergence around the supervisory practices. Alexander said that very eloquently as well. There shouldn't be examples where there are different grandfathering regimes or different interpretations by national competent authorities, but it will take time to build that. And I think, as we can look at how Europe, the legislation evolves and how the framework actually works in practice, then I think we have to have the courage to say, okay, this, that, and that didn't work the way we wanted to. So let's change that. There might be other things that need to be put in as well in future. Who knows? As other jurisdictions catch up, because the EU went first or went very early. There's no reason to say that the EU might not need to evolve the MiCA framework in a couple of years' time, when we see how it works on the ground and when we see what other jurisdictions do. So I think, that built-in review process that the legislation has is positive. I think, we don't want to be changing the legislative framework all the time, because that does give you a lack of certainty and undermines the stability that can come from a legislative framework. But equally, looking at whether we've got the balance right between level 1 and level 2, and whether it's all working on the ground in the way it was intended, that's an important exercise to do. And I think we should probably look at that over the course of the next few years as other jurisdictions catch up.
Very well. Matthew, I know that there was an area you were mostly thinking of. For instance, if you ever think about issuing your USD stablecoin in the EU, I guess that you would need some sort of regulatory convergence to reduce the frictions, or do you think that even if there is no regulatory convergence, you can do this in the future?
Yeah, so MiCA, first of all, MiCA doesn't contain a recognition element, unlike other major pieces of EU financial services legislation. And just to explain a little bit, the equivalence mechanism means that provided a jurisdiction overseas meets equivalent standards to those of the EU, then firms from that jurisdiction can offer services in the EU. So there's a good reason why MiCA doesn't have that, which is that this market is still developing. Jurisdictions around the world are still developing their regulatory frameworks for MiCA. So we recognise there's a kind of good reason for that. But I do think that it's something that is worth working towards in this space, particularly for stable coins. And let me explain a little more about that. So today, an issuer of a USD stablecoin in the US, if they want that stablecoin to be available in the EU, they need to apply for a local license, and they actually need to issue the stablecoin locally. And what that means is that they actually need to have a different stablecoin, essentially, an EU version of their stablecoin that circulates in the EU, and then the backing assets for that also in the EU. So you force a stable coin to sort of bifurcate into two local versions. And I think that creates some really important challenges for stable coins. I think it undermines the benefits of stable coins to some extent. I mean, the idea of stable coins is to be a token that can be used to deliver value anywhere in the world. So now you have this conversion process, which adds some friction into a payments chain between the EU and other jurisdictions. And I also think it poses risks. So if those two local stable coins get disconnected for some reason, this could cause risks, including to financial stability. So while I think a recognition regime should be a long-term objective in this space, I think there are some things to do even now. So, if there is a good relationship between the EU authorities and the home regulator of a stablecoin, if that's a well-respected regulator, there should be scope for close supervisory cooperation between the regulators to come up with a proportionate framework. So at least within the sort of bounds established by MiCA, we can have the most fungibility as is possible for a stablecoin issued under this framework.
Perfect. Alexander, anything to add from your side?
Yeah, maybe only that I strongly believe that Europe is setting a pace, whether you want to call it Brussels effect or not, absolutely, implicitly or explicitly. Implicitly, because why should you reinvent the wheel? And you want to do business with the European Union afterwards. So why shouldn't you take most of the regulatory framework into your framework, or at least make it accessible? It would be dumb not to do so. And that, in that respect, we are, or you, yeah, we all, or our regulators on the European as well as national level, are really on the forefront doing that. Absolutely, I strongly believe so. And it's also for me a necessity to stay independent from whatever will come from the US, because you don't know what comes from the US, and not everything that necessarily is positive that's coming from the regulatory framework that might be developed. So for me, this is also a very important part to stay independent. I think one aspect that we tapped several times into is the stablecoin thing. And although there might be some use cases that might be covered by CDBCs or deposit tokens or other means of stable coins in the future in European level, I think that the flexibility of stable coins, especially when it comes to real-world asset tokenization, is so huge that it is actually the missing link. Because when we talk about mobility, energy, whatever, up and down, it doesn't make sense to have proprietary coins on private chains for every use case. So you want to have this one normalized token that you can use on myriads of use cases, standardized, highly regulated, everybody can use it, and it's accessible to everybody. And that is the stablecoin under the MiCA regime. And so for me, that is the big thing, the big block. And this will also be something that will be used widely outside of the European Union.
Perfect. So thank you so much. So now let's move to the questions from the audience. We have some questions. So I mean, there's one which is very much linked to what we are now discussing, and I'll read it out loud. With the implementation of MiCA, how do you perceive the impact of this regulation on the competitiveness of European companies compared to other global markets, such as the US and Asia, which are still developing their own regulatory framework? So I don't know if there's anyone of you who would like to take this question.
Yeah, I mean, I have a quick go, and I think Alexander wants to compliment as well. It's difficult to say, obviously, because the rules don't apply yet. So, the framework is there. We've had some certainty in terms of the high level, but we're still waiting for some of the level 2 and the level 3 work. And until such time as that's kind of available, it will be difficult, I think, to judge, kind of whether it's met its goals. The other point, as I said before, as other jurisdictions are building up their framework, then we will also be able to get a better understanding as to the interplay between them. And I think that is important from a competitiveness perspective, which was mentioned in the question. It's not to say that a light touch regime is going to be better or worse than a more robust regime, but there will necessarily be consequences if we do see divergence in approach from some of the bigger jurisdictions. It's impossible to have total consistency and convergence at a global level. We'd all like that in this sector, and I think across traditional finance as well. But we realise that that's not always possible. What we should try to avoid, though, is significant differences, and I think that's where, from a European perspective, MiCA as it is now, provides a good framework. Once we see all the granular detail at level 2 and level 3, we have to look at whether that's doing what it was designed to do. Is it fit for purpose for our own regime? And I agree with what Alexander said. We need to build for ourselves in Europe, and then others do what they want. But we also need to be mindful that if we go further in other areas, and we know that the Commission might be looking at things like DeFi and NFTs, and if there's a kind of the usual business as usual approach in Brussels, where we come out with more legislation and get more mandates for the ESAs to do more work, there could be a risk that we are stifling some innovation, and that other jurisdictions that have a more principles-based approach and don't go to that level of detail that we do, from a business perspective, might look more attractive. And so that is something I generally tend to think the regulation at European level is positive, because it brings that stability, it brings that credibility. But if others take a very different approach, then that's something that we have to be mindful of, because that could turn out to be a competitive disadvantage for Europe.
Very well, thank you so much. So we have one of the members in our audience seems to be fascinated with your stable coin, Matthew. So we have 3 questions in that regard. So I'm going to read them out loud so that the rest of the audience knows what we're talking about. So RLUSD is a stable coin pegged to the US dollar with the aim of providing stable value and complying with the requirements of MiCA as well as other regulations. Is the XRP token associated with the use of RLUSD? By using RLUSD as a means of payment and making cross-border transfers, could XRP, the token, appreciate with demand? Also, please explain further how XRP is a deflationary token. Will XRP play an important role in the IMF's special drawing rights? And RLUSD as a digital cash for dollars, and XRP as the global courier that connects everyone. So a few questions trying to get a grasp of how your stablecoin will work, I think.
Yeah, thanks for the questions. So this has been a question that we've been asked quite a lot. So just to explain how RLUSD and XRP sort of relate to one another. So today in our global payment solution, XRP is used as the bridge asset. So it's the asset that's used to deliver value across the world. Once RLUSD is available, that will be available as an option to be used as the bridge asset instead. So in that sense, that XRP and RLUSD will be available and will complement each other. But it's important to say also that XRP will still play a key role because it'll remain the native crypto asset in the XRP ledger ecosystem. So it's sort of used a bit like gas in that ecosystem. So it still has a very important role to play. The other questions, will XRP play an important role in the IMF's SDRs? I don't know about that. Not to my knowledge, but I could. There may be something I'm not aware of. And sorry, what was the third? I'm just struggling to scroll down. RLUSD is digital cash for dollars, and XRP is the. So like I said, so RLUSD will be available as a sort of settlement asset within the payment system, and then XRP will play a role as the native crypto asset of the ledger. I think that's the best way to think about it.
Thank you so much. And we have one final question, and I know that some of you are not going to like it. I mean, not the first part of the question, but the second one. So the first part is, in your view, what could be done to prevent the illicit use of stable coins via unhosted wallets? Now, the part that you will not like, MiCA regulation 2.0. Who wants to take this one?
I can take it and then jump on me. Yeah. I'm not really sure whether I get the question, don't get me wrong, but I don't really know. I'm not really sure how to tackle that. But the point is, I mean, we create e-money tokens. Don't get me wrong. So legally, it's an e-money token. It's not commercial bank money, but it is money, and with a full 100% representation of the euro. So after under the rule set, after the first buyer got the token, the e-money token, the token can be used where the token can be used. It's like real cash. So what do we do with the euro after I took it from the ATM? Who's following that single euro piece that I have in my pocket? Where's it coming from? Yeah, so we got to be careful that we treat apples with apples. Yeah, and take the same rule set. Yeah, so I think we have a very sound rule set and a very, very strict rule set also on the redemption side when it comes to token redemption and handing out the fiat against the the e-money token once again and double checking and where the money is coming from, source of funds, source of wealth, who's redeeming the tokens. I think we're very secure there. But after the first buyer got the e-money tokens, it's up to them to use them. And if they want to use them on an unhosted wallet, they use them on unhosted wallets. If we would try to regulate that, then we should try to regulate that on how normal fiat money is used globally, which I think we can't. So in that respect, I don't know whether this is the answer that we want to hear, but I think this is how it works and how it should also work. We have to be very diligent at the beginning. The rule set is very strict. KYC, AML, first buyer. Then it can be used where it can be used. And then on the redemption point, we do all the checks and balances, where the person's coming from, where the funds are coming from. Is the person eligible to receive the fiat money once again? Yeah, rule set is pretty safe there. But in between, you use it as you want to use it.
Perfect. Mark, please.
Yeah, thanks. I agree with Alexander there entirely. I'd just add, for me, this is not really a MiCA point. It's more other parts of legislation. So, we have the travel rule internationally in the FATF work. We've got that now implemented in the EU as the transfer of funds regulation. Anyone who's an EMI, as Alexander will know and is explaining, there's already the AML rules that apply for. So there's also a misconception sometimes that crypto in general is totally unregulated because MiCA before MiCA. It's not true. If you have an e-money license, you apply the AML rules as per other providers. So I don't think this is really something necessarily that will be part of MiCA 2.0. I'd also say that, yes, self-hosted wallets or unhosted wallet, however you want to describe them, they are an important part, a huge part of Web3 and the ability to be able to do things, including on the privacy side of things. Now, anybody who's got that, especially if you're doing custodian, it's unhosted, but if you still have often a point where the KYC has been done. If you're getting a wallet that's been, it doesn't have to be hosted by, but you've got your on and off ramps of getting fiat currency into kind of on-chain stable coins. So there's already a huge amount of KYC rules and provisions that apply and requirements on those kind of centralized entities that are the point of conversion. And I think that is probably enough for making sure that illicit finance activity, which happens everywhere. I don't think this industry, particularly with the blockchain nature being very transparent anyway, is not a good way to be able to be doing illicit activities. But I think that's probably already covered. And so the question about MiCA 2.0 perhaps is more around decentralization as a whole and DeFi. Again, that's a whole other debate. But I think at the moment the Commission is thinking that there's no financial stability risk by DeFi. It's a relatively small, albeit nascent area. And also the importance of keeping that kind of protocol level open and free of regulation, because that's basically how the system works. You can still regulate the entities at the top, where there's interaction between citizens and businesses and firms. But I think that's at least how we see it at the moment. The importance of keeping the lower level as almost as a public good.
Very well. Thank you so much. Do you have any further comments? Okay, so thank you so much. I really want to wholeheartedly thank you because you've all been brilliant. I've learned a lot with this webinar. So in FevSecTly, we will keep on working on crypto assets. We'll also try to make public a short policy paper outlining some of the elements that have been brought to the table today. And we stay in touch again. Thank you so much.
Thank you. Have a good day.
Thank you.
Bye.
Thanks very much.
Thank
Bye-bye.
you.